Welcome back to Eye on the Money, and we're discussing debt management with Timothy Gathima, credit expert at Sandbox. Now, before we went on break, Timothy, you were pretty much explaining to us the concept of bankruptcy, as it's one of those routes that's provided for the law for someone who feels like they're struggling. It gives some sort of leeway to get your house in order. However, you also mentioned the repercussions that come with this, and that being listed at the CRB, and you'll have that reputation of just not paying your debts. My question then is on the credit score. What does failure to pay someone's debt have to do with credit scores? Because that's something I also saw in your survey. I would like you to explain to us that aspect of the impact of just bad debt, not paying your debt, on someone's credit score, and ideally what someone can do to improve the same.
Okay, so at the very basic level, and I think I can explain it this way. When we're growing up in our villages, we had the shopkeeper who would give credit, would give goods on credit to the family, and you as a child would be sent, go pick up salt, go get cooking oil, that kind of stuff. And at the end of the month, your parents had to settle the bill. And when they didn't settle the bill on time, you no longer had access to that credit. You now had to go with cash each and every time. And the credit score works more or less in the same way. It's your reputation as an individual or as a business with the lending institution. And they look at different things. And there's a reason why they look at those different things. They look at them and say, if you paid on time each and every time, then we know that we can trust you. If you defaulted maybe on one of the facilities that they have with you, then they start looking at your ability to repay based on your past performance. And that's basically what the credit score is.
Right.
And at the tail end of it is bankruptcy, where you say, I'm completely unable to pay, my assets do not cover my liabilities, I cannot pay at all. The interesting thing about Kenya and some countries in Africa and some of the less developed countries is that once you're listed with the CRBs, then no financial institution wants to touch you. And what that does is that it opens up the space for other lenders. So you have Shylocks, you have these people who come in with very predatory lending rates. And I wish our banks would look at listing as not fatal. Look at it as something that can actually be, that can be cured. And how they do this is through something called risk-based pricing. What it means is, for the people who are higher risk, you get higher interest, and you're kept on a shorter leash. You get shorter term loans with higher interest until you build up your reputation again as somebody who can pay. For people who've been excellent from day one, you can walk into your bank and get a cheap mortgage. You can get a cheap, you can get a credit card. You can get your overdraft facility, and that also encourages people to repay their debts on time. It encourages people to always be faithful as far as their debt repayments are concerned. And I think it will also open up the lending space to everyone. And when I say to the lending space, I'm talking about commercial banks in particular. So the failure of the banks to address this issue of the credit, of the risk-based pricing, their failure to address it has opened up the space to mobile lending, some lending apps which will lend you whether you're listed or not. Right. And these apps are predatory as far as the rates are concerned. It's led to the growth of SACCOs. So right now, SACCOs are actually, they have the capacity to slowly take over this market share that the banks, should be relying on. So at the end of the day, if the banks don't get their act in order, somebody will, and somebody will take up their customers.
Now, Timothy, I've had a few conversations before with some, financial experts who will say, what, Ingrid, debt is not the worst thing in the world. There's actually such thing as good debt and bad debt. You can actually take out debt, and it's just not the worst thing in the world. So I'd just like to hear your views on, what's the difference between good debt and bad debt? When is it okay to take out debt? And how do you make sure you don't cross over into the red, and then you get on the other side where it becomes a burden?
Okay, so when you look at really wealthy people, they build their wealth on debt. You'll have a person walk into a financial institution, get a facility, and use that money to build more wealth. And that's what you would categorize as good debt. Good debt is basically money that you borrow at a rate that is low, going to it. That's the simplest definition I can give you.
That's actually the perfect definition.
That's the perfect definition of what is good debt. And so, as an individual, as a company, as an SME, you need to look at what it is you're borrowing this money for. And if you're borrowing this money to make money, number one, but two, that the money that you're borrowing is cheaper than what you're earning, then good debt. Please go ahead and do it. That is going to make you wealthy. Bad debt starts by, when you look at the use for the money. Are you borrowing money? I've come across instances where people actually took loans to go on holiday, and I've come across also instances where somebody took a credit card, went to a supermarket and shopped goods and took them up country to his wife's kiosk.
Right.
So not only did he buy things at retail price, he also incurred, the credit card charges, and they were going to sell these goods at a loss because this is up country and price, it's price sensitive. So there are those kind of examples of bad debt. And as if you're getting, for example, into a real estate project, you need to work out how much you're borrowing against what the actually is a mortgage to build a house. This is a classic example because I've done quite a bit in terms of real estate and financing in that sense. Somebody will take a 5 million shilling mortgage to buy a house, and the repayment on a 5 million shilling mortgage is something close to at 70 or 80,000. Yet that house can only rent for 30,000 shillings. So that's a terrible debt.
Right.
Don't do it. You'd rather save with your circle, get your 1% per month loan. You'll probably be able to just scrape by and make that payment. Those are to think about. But then talk to somebody who knows about debt, because people are making decisions. I mean, you wouldn't go to the farm if you're sick. You wouldn't go to the pharmacy and just buy whatever medicine. You have to talk to the doctor.
Right.
The doctor will prescribe the medicine, and then you will, because you trust the doctor. So we also need to develop some sort of trust with people who know finance works, how debts work, how loans work. And I think if you do that, you should be able to distinguish very clearly between what is bad debt and what is good debt.
Thank you so much. I can't say thank you enough, because I feel like this is a very timely topic. A lot of people are really, really going through it during this period. People are so stuck when it comes to their finances, again, because they've lost their jobs. So you've provided very, very valuable insight. And I'm truly grateful that you're able to make time to join us today here at Timothy.
You're welcome.
We've come to the tail end of the show today on Eye on the Money. You can be a part of the conversation by sending your feedback to our social media handles at Metropole TV KE on Facebook, Instagram, and Twitter. Don't go anywhere, because there's a lot more amazing programming right here on Metropole TV.